Hi guys, welcome to Money Control. I'm Karunya Rao, and today we'll be discussing and decoding a very interesting report that has been published by my colleague from MC Pro, Madhuchanda Day. She's the head of research. She joins us now to tell us why is it a good idea to look at markets at the current juncture. Madhu, the title itself is very, very intriguing. Good time to look at the markets when there is blood on the street. Well, there literally is blood on the street, but tell us about, what is the thought behind this? Because right now, a lot of people are jittery, still very, very wary of, dipping into the markets.
Yeah, as we have seen, not only with wars, but with, say, COVID-led correction in March 2020, looking back, investors would agree that the best time to invest in the market is when there is blood on the street. And, interesting thing is we were doing some research on how markets have reacted to wars in the past. And it is not just recent times. Way back in the time of, say, World War II, say between 1939 onwards, markets had given a positive return of 50% during the Second World War, annualized return of about 7%. Even during the, say, the Vietnam War or the Gulf War, the market had a steep correction, but that was followed by a sharp recovery. So overall, S&P 500 in the course of history has given a positive double-digit return 1 year after the war. So, as the saying goes, history repeats itself. So every time there is a conflict like this, there is a stress amongst investors like this, they need to go back to the history.
Okay, so nothing changes this time around as well, according to your assessment. But, people that we've been talking to, they also said it's not just the Russia-Ukraine tension. There is a big worry with respect to inflation, with respect to increase in rate hikes, but of course, inflation being the larger worry here. So if we look at the various headwinds that the markets are facing across the world, what is the biggest worry, to look at?
Yeah, absolutely right. I think Ukraine conflict, although it's the talk of the world now, it's a sideshow compared to the bigger worry of inflation. The world has never seen this kind of an inflation after the Second World War. The US latest inflation print in the month of January was 7.5%. And crude oil prices have increased by over 50% in the last 1 year. So definitely inflation is a monster, and that is what all the global central banks are trying to rein in on. So definitely inflation is a bigger worry. And in that context, this strife is extremely important because Russia is one of the largest exporter of not only crude oil, but various other commodities. So any conflict involving Russia has already taken crude to soaring highs, and it will definitely have an impact on commodity prices, and inflation looks here to stay.
Madhu, how long before, Indian markets also start feeling the heat of inflation meaningfully, or, inflation plays out in the Indian economy as well?
See, inflation has already started playing out in the Indian economy. If you see the earnings report in Q3, while most of the companies have seen better top-line traction because, the December quarter was better in terms of demand. But inflation, like gross margin pressure, was there across the board. But most of the large Indian companies, they have been very good with cost management. They have taken, cost cutting to the limit during the COVID pandemic to tie down the prices. Yeah. And that has kind of shielded the EBITDA margin to some extent. But yes, gross margin pressure was killing for many companies. That has already started playing out.
Right. So, which are these companies which could perhaps witness more earnings pressure, more pressure on the stock price, and overall visibility in terms of growth? Because yes, across the board there's inflation in different commodities, different raw materials as well. So, who could be the worst victims?
See, we have seen right from, say, an FMCG company to cement to, raw materials for steel. The inflationary pressure was everywhere. So the thing that could help Indian companies going forward is Q4 will be a slightly impacted quarter because the first month of Q4 was not great because there was some disruption due to the Omicron, but Omicron was fast to go. So hopefully the first quarter of the next fiscal FY23 should be normal in terms of demand. And many of the companies, if the demand comes back, they will have pricing power to pass on some of the inflationary impact. So I think growth will take care of earnings to some extent. So unless and until there is any catastrophe, I think growth will take care of earnings to some extent. So we don't foresee a major earnings downgrade because of the inflationary pressure at this point in time. Unless and until, crude goes to some level, which is not something which we have ever seen.
Well, that is quite relieving to know, Madhu, but I feel like you're being very optimistic here because if I look at your report as well, amid all the gloom and doom, you're talking about a lot of positives and silver linings to look at. So, with every time the market capitulates, it seems this time is going to be different, right? But going by the history, but if I look at the current scenario, your report says that the armed conflict in Ukraine will not have any long-lasting impact on the market. Why is that?
Yes, absolutely true. That is what we expect because, see, Ukraine is neither a member of EU nor NATO. So we don't see Western powers actually going into the field and fighting this war. It's going to be a localized conflict. And should it be a localized conflict, it is unlikely to translate into, the so-called fear of the Third World War involving many of the global powers. That seems unlikely at this stage. And so far, Western nations have talked about sanctions, but the sanctions have been so-called very cosmetic in nature. It is not going to dent Russia in a big way unless and until Russia is kind of excluded from the global payment system. That looks very unlikely because there's a lot of dependence of Europe on Russian gas. So we feel that this conflict is going to be localized. It is unlikely to disrupt a global supply chain, which was disrupted already because of COVID. So we don't see that this disrupting global supply chain incrementally. So yeah, it's going to be a localized conflict with impact on commodities, which is already there. But we don't see, it translating into something very big. So yeah, there has been an impact on the market, but it is likely to be short-lived.
Well, again, good to know. But what happens to the rate hike? Will it be less intense, the US Fed's rate hike in March and subsequently the rate hike by RBI as well? Could it be more benign?
Well, technically speaking, in an inflationary environment like this, rate hike need not be benign and should not be benign. But suppose if the conflict continues well beyond March, US Fed is not going to ratchet up rate by 50 basis points for sure, because amid such a volatile global milieu. So it would be a 25 basis points kind of a rate hike for sure. The probability of a 50 basis point rate hike has reduced ever since the crisis broke out in Ukraine, Russia. But having said that, the future course of the rate hike will depend on the longevity of this conflict, how it impacts commodity prices, how it impacts growth in turn. So yeah, it brings a new dose of uncertainty for future rate hikes as well.
Let's talk, what's happening specifically in India, because in the past, FIIs used to rule the buses, but there's been massive selling on that front. But your report says that the Indian market's long-term journey will ride on domestic liquidity. What makes you say that?
Absolutely. If you see, the color of money is changing, and that is changing for the better. If you remember, like at the start of our career, it was a FII dependent market. So the only data that we used to track was, FII buying, FII selling, right? But today, mutual funds assets are at a record high. We have record high SIPs. Even the January figure was a record high SIP. And you see the kind of demat accounts that got opened in the last 2 years during the pandemic. So yeah, there is a lot of Indian money which is going to come into the market. And remember that the new generation, it's a generation of Indians without a pension, and there is a negative real interest rate. So where will money go other than equities? So definitely domestic liquidity is going to be a solid support for equities going forward. And that should kind of, prevent any major sell-off in the market.
But is it sufficient? Because the majority of these people that you're talking about, they're retail investors. So can they really cushion meaningfully, the impact of FII selling? Relentless FII selling, might I add.
There is FII selling, but every day if you check the figures, there is a strong domestic buying also. And eventually, what matters for Indian markets is not the liquidity alone, but it is the earnings outlook. So if earnings outlook is there, which is positive at this point in time, then I think money will find way into the market. So yeah, there will be a volatility because of the FII selling, but at the end of the day, it will be the earnings which will do the talking.
Okay, but coming to the big question, I'm sure our viewers would also like to know. As all the volatility, geopolitical tension and everything is playing out, what should you buy? What are these sectors or what are these pockets in the market that show promise?
Okay, so while just a caveat, you mentioned that my report was excessively positive. While I sounded positive from a long-term perspective, I have cautioned investors that this is not a time to experiment with stocks,
Yeah.
And this is a very, very different year. 2022 is going to be a very, very different year from 2020 or 2021. So let me start by saying that 2020 or 2021 were years of easy money making because there was a lot of liquidity which lifted all boats. So all kinds of stocks went up in the market and making money and, being a star investor was rather easy. But 2022 is going to be a different year. So you have to be very, very careful with your stock picking. And to start with, if there is a capitulation of the order, which we saw yesterday, of course, markets have staged a smart comeback today. But what we saw yesterday was a 5% kind of a downtick on the Nifty, and with many stocks, correcting in double digits. In times like this, it's best to stick to, quality, because you can only buy quality when there is a steep correction like this. So stick to blue chips, companies with solid balance sheet, leadership, position in their respective industries, and the moats. So these are the kind of businesses you should buy. But yeah, going beyond that, I think there is enough opportunity in the Indian markets, which you can look at, and research houses, including us. So we give you enough and more of those ideas. So do subscribe to MC Pro for
Madhu is going to be tight-lipped. She would urge everybody to subscribe to MC Pro if you want those exclusive stock ideas. So she's not going to reveal anything here. But definitely blue chips is something, you're betting on right now.
Yeah, but there are enough and more sectoral trends also, which are very interesting. For instance, just to give you some nuggets of where we see a lot of positive traction in terms of earnings. I can't tell you in terms of stock price, but definitely in terms of earnings, the pockets that makes us positive. One is financial, especially some of the large private sector banks. Their balance sheet is squeaky clean. They have more than enough provision. And if credit growth picks up, which is very likely with the overall economic recovery, banks are in for very interesting times, very strong earnings traction. And a rising rate scenario is definitely not an advantage for NBFCs, but banks tend to improve margins to start with when the interest rates start rising. And that NPA problem is kind of addressed on the corporate side, though it is very well managed. On the retail side also, with the recovery, with the economy opening up, it should improve. So definitely private sector banks, select financials are looking very good, especially since they have not performed in the last few months. The other pocket, which is interesting, is the whole export, especially given that, because of the volatility, etc., the currency looks a little shaky. And we are extremely positive on the general IT service sector, because as we all know, the demand is like in a decadal high. We have never seen this kind of a demand. Companies have never seen this kind of a demand. While resource crunch was a kind of a problem to start with, because they never expected this kind of a demand traction post-COVID. So they were kind of taken by surprise. So there were all kinds of wage pressure. But I think companies have, managed to address this on a war footing. So maybe 2-3 quarters down the line, that problem should abate. And hence, we could see very, very decent top line as well as margin performance from these companies. So that is also another pocket which is looking interesting. And then this entire import substitution, having a second supply base away from China, that involves a whole lot of companies in the chemicals, pharma research space, which we like, and we have been suggesting those names. Even on the capital goods side, the Q3 earnings call revealed that many of the companies are getting very, very interesting order pipeline. The order books are surging. So yeah, any company with a strong balance sheet over there looks good. Even the Atmanirbhar theme, PLI,
Madhu,
those
you were talking
look
about financials, and I have to ask you, how does the ongoing scenario impact sentiment ahead of LIC IPO, which is going to be launched very soon?
Yeah, I think LIC IPO is a very significant event for the markets. And as of now, I don't think the current crisis will have much of an impact on the IPO. I think markets have the depth to absorb the size of the IPO that government has planned for the initial stage. It is not going to be a 10% kind of a divestment. It's going to be a 5% kind of a divestment. And we don't have any major big ticket IPOs lined up ahead of the LIC IPO in March. So I think it should sail through. And from all indications, I think they're going to leave some money on the table for the investors. And that should be really exciting for the investors. And I don't see a challenge for the LIC IPO, honestly.
Just one more question, Madhu, on the tech space. You track the sector very closely, both heavyweights as well as some of these smaller new age companies. Right now, given the market correction, how are the valuations looking? Is it a good time to enter some of these names? People who missed the bus, entering before and making good profits. Is this a good time to perhaps add it?
See, as far as IT service sector is concerned, if you're talking about the mid-cap IT companies, which were trading at, say, DZ valuation at one point in time, but in the last 3 months, despite their Q3 earnings being very, very strong, Q3 normally is a seasonally weak quarter because Indian IT service companies have a huge exposure to the financial service sector, and because of the furloughs, etc., typically Q3 tends to be a seasonally weak quarter. But albeit the seasonality, I think most of the companies have had a very, very good quarter, but the stock prices have corrected because of the global correction in technology. So in line with that, most of the technology companies have corrected. So that looks to be a strong pocket according to us. But if you're asking me about new age companies where valuations are riding on hope, I would still be extremely circumspect.
Okay. One word for new investors who are panicking right now because they've never witnessed this kind of, insane amount of volatility or, selling pressure, etc. on certain given days. How should they cope and how should they strategize their journey?
See, it's very simple. you are there in the market for the long haul. You're not here to make money, invest today, make money tomorrow, and exit day after. That should not be the approach. The approach should be like an investor and not a trader. This is not going to be a great year for an investor, but a very bad year for a trader. So yeah, invest in high quality businesses. Don't put all your eggs in one basket. Don't put all your money in one tranche. And definitely take advantage of capitulation in the market and stick to the right kind of stocks. And I think you're here to make money in the long run.
All right, Madhu. On that note, we'll wrap up the chat. Thank you so much once again for joining in, sharing the insights from your report and telling investors and our viewers why it's still not a bad time to dive right into the markets. Thanks once again, and thank you for all our viewers for tuning in.